welcome to the Monday Futures Market Outlook for October 31st, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that we've gone through. 3 months ago, we bearishly crossed below that 80-week moving average, giving indications that a new bear market may have begun. But we very quickly find ourselves now trading back above that 80-week moving average. While that's not uncommon for there to be these sequences where there's temporary breaks below and then back above a moving average within technical analysis, we sort of want to use this as a benchmark level of indicating the primary trend. And so long as the bulls can, in a very healthy way, maintain this market above the 1200 level over the upcoming weeks, it certainly would be an indication that there's room for the market not only to test its previous highs, but still maybe even make progress back towards 14 or 1500 on the S&P. While it's too early to start making a lot of bullish scenarios, one must recognize the strength that we've seen in the last 2-3 weeks as a very good indication that the selling pressure that was going on during that August and September month has now subsided. Just to make some key intermarket observations, we have seen some key bottoms in the stocks and commodities, which will more than likely mark the lows of this year, and particularly the way the market and commodities rip through overhead resistance levels, like if it didn't even matter, as an indication that buyers have real momentum behind them as people are feeling left out. A lot of money was on the sidelines. A lot of individuals were identifying the bear market environment. And so as the market starts rallying, everyone's buying such an intense level that we are now at quite significantly overbought levels. In fact, some of the overbought indicators that we use that are market breadth oriented have actually reached new highs for the entire 2011 year. Even though the stock market has not exceeded the highs of the year, we certainly have seen a lot of these overbought signals already make some pretty significant highs. It doesn't necessarily make anything bearish. It's just an indication of the sheer amount of buying strength we've seen in the last little while. So really the environment has dynamically shifted as investor fears have now been snubbed out by greed, and money is coming back into the market as though immediate risks have been removed off the table. Overall, if this is going to be the case, and especially if over the next few days, if we see that all pullbacks are being supported and bought, it is likely to be financially dangerous to fight this momentum. So even if you're skeptical about the sustainability of the rally, don't put too much probability on any sustained short sell bets. So if anyone wants to swing trade lower on short bets, they can do so, but recognize that a sustained short sell will probably, the opportunity for that will emerge probably in the new year, sometime after a year-end rally, but it's not a very high probability bet at this juncture within the market. When we take a look at the daily chart of the S&P 500, you can see that massive update that we had in the last week, and really at this stage, there's obviously going to be a little bit of backfilling after such a robust move. But so long as pullbacks are really contained into the any price action into the 1200 zone, so 1200, 1210, 1240, all these areas are supported, and buyers are buying off that level. If there's no real follow through selling that does damage, the buyers will very quickly accumulate that weakness, and it'll vault the market probably towards the highs of the year. So watch these sell-offs. It would take a very big news-driven catalyst to wipe out, let's say, the 1210 to 1220 focal point, and it would be below there we would have to consider bearish scenarios. But really, even right now, if we saw even a 30 or 40 S&P point pullback, even in one day, that is immediately accumulated, it would actually do no bearish technical damage. Next here, I want to take a look at the US dollar index, and this is where a lot of the cross currents are coming from. Overall, we had a very nice clean uptrend on the US dollar. They had plenty of room for the dollar to actually continue higher in a nice uptrend while the euro is weakening. And really at this stage, the euro strengthened considerably, and a lot of the other cross currencies strengthened, and suddenly we find the US dollar having completely wiped out the vast majority of its last rally. Really at this stage, that puts the US dollar into a far more neutral position. Now, it doesn't necessarily make it US dollar bearish, but it's certainly not US dollar bullish. And we really want to watch what the price action does, particularly if there is any good push higher in the US dollar for 1 or 2 3-day push, let's say to 77, 78. It'll be very important to see whether or not the bulls support that rally, or whether the US dollar bears sell it off all the way back down to its lows. If we see any short-term rallies immediately sold, it would be an indication that the dollar is going to go nowhere for a while. Next year, when we take a look at copper futures, copper had a very robust week. After banging out that double bottom, it just shot higher, breaking the neckline and actually almost making it all the way to our 380, 390 overhead resistance. Really at this stage, copper certainly has room to do what we call a throwback, where we're going to see even testing of that 350, 340 area on the downside. But so long as those supports are held, and then we still could see copper properly test the 390 and even maybe even the $4 level on the upside. So while that doesn't make me in the big picture like bullish on copper for a robust bull market, we certainly can identify the short-term selling pressure that was around on copper in that July, August, September cycle has really subsided, and at this stage we have to look at the metal in a far more neutral light. Next year, when we take a look at gold and gold futures, we really have seen the immediate sell cycle fear subside as the market made a very strong push above the 1700 area. While gold has not exceeded its Fibonacci retracement zones, so therefore we can't really become outright bullish on gold here yet. At least we know that the immediate sell signals that were going on last week have been neutralized. So really at this stage, after such a bullish push, the most important information will come to the degree of the selling in gold. If really at this stage gold contains everything to 1680, 1700, and we don't really see that 17,720 focal point beaten on the downside for any sustained period, and the gold could roll up and make another push back to its previous highs at 1900. But right now, it's too early to make that kind of a call, because if gold was to wipe out down to 1650 or lower in one fluid motion, that would immediately put a lot of bearish scenarios back in play in gold. So we don't want to we want to remain relatively neutral and flexible enough to trade gold either direction, as it really has not yet given a good indication of whether it has been able to break the downtrend that's been in place for the last 2 months. Next year, I want to take a look at crude oil, and when crude oil made a nice push above that 90-92 support line, again neutralizing the immediate sell signals that may have been occurring in crude at this stage. Just like copper or anything else, we're looking to see if all the pullbacks can be contained to just simple retracements. If we see the 90 and 88 levels and so on holding the support along crude oil, and then we have a nice bullish reversal back up, we could see $100 a barrel crude oil by the end of the year. So let's watch to see how these consolidations occur. And I think it would be the area where I'd be starting to look at far more negative scenarios for crude oil would be if we saw crude trading below $85 a barrel. So even if you see a $2, $3 pullback, that would not be necessarily bearish. It would just simply be a much needed breather for crude oil from this uptrend that's had for over a month. Finally, I want to take a look at those 30-year Treasury bonds. When we had that double top come in, we were looking to see whether the support lines around the 138 line were going to hold, but last week certainly had them break all the way down to where the lows were coming in August around that 134, 135 level on those treasury bonds. We're already seeing a couple of strong reversal candles wiping out the last sell cycle. There's certainly room for treasuries to work their way back to test the 140, 142 level, but this is going to be a crucial rally in treasury bonds, because if we find overhead resistance and treasury bonds roll down, let's say at or below the 140, 142 level, it really may mark the end of that bullish push in treasury bonds and really begin to see some deeper sustained consolidations lower on those as the yields will start to rise. That was your Monday Futures Market Outlook. Thank you for joining me.